Good morning, everyone, and thank you for joining us today. My name is Maddie Frechette, and on behalf of KLR and our affiliate companies, I want to welcome you to our 2025 Year-End Tax and Business Planning webinar. As we approach the end of the year, many of you are likely looking for ways to maximize tax savings and plan ahead for 2026, especially with updates related to the One Big Beautiful Bill Act, Secure 2.0, Opportunity Zones, and much more. Today, we'll cover just that and answer your questions in this webinar. I am joined here today by three of our KLR partners, Laura Yolanis, Partner and Director of Tax Services, Anthony Mangiarelli, Partner and Director of our Strategic Business Solutions Group, and Joseph Tamburo, Partner in our Tax Services Group. If we don't get to your questions during the session, we'll be sure to follow up with you offline. As a reminder, a link to the recording of today's session will be sent via email this afternoon. All attendees will also be the first to receive a link to download our 2025 year-end tax planning guides for both individuals and businesses. And with that, I'll turn things over to you, Anthony.
Thank you, Madison, and welcome to the big show. Want to recognize while we're at it, Madison, June Landry, our amazing Chief Marketing Officer, and the rest of that amazing marketing team who make this all possible. Good morning, and thank you all in advance for your time and attention. Many of you know Laura and I, but this year we're welcoming Joe to the show as well. He doesn't know it yet, and don't tell him, but he's really auditioning for my role as I plan for my sunset into retirement. So Joe, we're going to find out if three's company or three's a crowd. So and he didn't coordinate with Laura and I on the colors, so the next year we'll work on that.
All right, sounds like a plan. Thanks for having me, Anthony.
So today's agenda, let's take a look at it and go over it. And the big thing is the OBBBA, whatever you want to call it. My spell check changes it back to OBBBA, and so I'm going to call it OBBBA with my accent. But what we're going to go over today is the key provisions in there, what's in that new law, the key tax changes for individuals and businesses. We're going to separate it a little bit. I'm going to go into the immediate year-end planning considerations, which is really the opportunity to make some changes in the next couple months to get some benefits out of OBBBA. Joe is going to take us through the opportunity zone updates because he's the best in the business at it. We're then going to go over Secure Act 2.0, which some of that we went over last year, but more of that provisions is starting to kick in, so we want to remind everybody. And then we'll go over some of the IRS enforcement and compliance items that we've been seeing that are top of mind for you to consider, as well as the economic landscape, which is one word, chaos. And we'll end with some general tax planning suggestions. And so with that, I will bring to the forefront my legendary partner that needs no introduction, Laura Yolanis, who will begin our coverage of OBBBA.
Thanks, Anthony. And you mentioned retirement, but surely that is quite some time from now, Anthony. You're still a young chicken there. So thanks for the introduction. Let's get into it. So the One Big Beautiful Bill Act, I kind of like to call it OB3, has a little bit of a Star Wars act to it. It's not OB1, it's OB3. So it's a little bit easier rolls off the tongue a little easier. So this is, for one thing, it is one bill. So President Trump did deliver. He got us one bill, and it is big. It is massive. There's just over 900 pages to the bill. In our short time with you today, there's no way we can touch on every provision in this bill. So we're going to try to hit the highlights and kind of give you a little bit of a roadmap for what the next few years look like and how it may impact you. Whether or not it's beautiful, I don't know. I think that's debatable. There are quite a few complicated calculations in here. There's more caps, there's more phase outs. So we can debate whether it's beautiful or not, but here we are. This was signed into law on July 4th of 2025. It does permanently extend, most of the TCJA provisions for both businesses and individuals, as well as for estate and gift tax. It also provides some temporary new deductions that we haven't seen before, and those are for seniors over the age of 65. The qualified tip income, we all remember during the campaign trail, no tax on tips was one of the big promises. There is something in here for that. Also for overtime pay and car loan interest. These are temporary provisions that start in 2025 and run through 2028. It also temporarily increases the SALT deduction to $40,000. I say for some because it's not going to impact everyone. This is one of those phase outs. Once your income reaches a certain level, that $40,000 can get reduced back down to the $10,000. And we'll get into those details in a bit. And then the one thing it did do that was probably not very favorable to the taxpayers was to cut back on many of the Inflation Reduction Act energy tax credits. Some of those have already expired under this new act, and many of them expire at the end of this year. So let's look at the how this impacts individuals. We'll touch on the permanent extensions first, and that was the higher standard deduction and tax brackets will remain. Before this bill was passed, we were looking at returning to 2017 deductions, 2017 tax brackets. It would have brought us back to a top tax bracket of 39.6. With this extension, it remains at 37%, and the standard deductions remain at that higher level, which for 2025, a single person deduction is $15,750. For a married filing joint, it's $31,500, and for head of household, it's $23,625. And then if you're over age 65, there's another couple $1,000 deductions on top of that. So you can see with these higher deductions, fewer and fewer people are actually itemizing. The other thing it did was permanently eliminate the personal exemptions, which, you know, those haven't been here since the passing of TCJA, so it doesn't really impact going forward, impact us. Child tax credit, that was scheduled to reduce back down to almost half of that. It is increased to $2,200, and it will be indexed for inflation starting in 2026. The mortgage interest deduction, previous to TCJA, we had $1 million plus $100,000 deduction debt limit that you could take the mortgage interest expense on. TCJA brought that level down to $750,000. That remains and is a permanent fixture now. Estate and gift tax exemption permanently increased to $15 million per individual starting in 2026, and then it will be indexed for inflation each year thereafter. So again, this is another provision that is going to drastically reduce those people who are subject to an estate tax upon their passing. But remember, that is a federal exemption. It is not state. Some states don't have an estate or gift tax. Many states do, and many states have much lower thresholds for their exemption. So you still have to plan for that if you are in one of those states. Some of the temporary provisions in OB3A, enhanced SALT deduction, we talked about that in the intro. In 2025, that cap has been raised from $10,000 to $40,000. But any joint filers and single filers have a $500,000 modified adjusted gross income threshold. Once you reach that threshold, your $40,000 phases down and gets back down to $10,000. So there's a lot of people who are very excited about this $40,000 deduction, especially high earners. However, those high earners probably aren't going to get the benefit of this. It'll be the moderate to lower income taxpayers who see the benefit of this. And that $40,000 will be adjusted for inflation And through 2029, in 2030, we revert back to the $10,000 limit. Car loan interest is another new thing this year. Of course, for businesses, car loan interest has always been deductible. This is for personal use vehicles, and it is only up to $10,000 of loan interest, and it must be on a new vehicle that has been assembled in the US. And that is from 2025 to 2028. Important note, leases don't qualify because technically you're not paying interest when you're paying a lease, you're making a lease payment. So if you want the benefit of this, it has to be a purchase with a loan. This phase out starts for those with modified adjusted gross income at 100,000 for single, and then 200,000 for married filing joint. So it's not a huge benefit that people will see. However, it's not nothing. So keep that in mind. If you have purchased a new vehicle and you have that loan, the interest could be deductible, and that is an above the line deduction. So it's not dependent on whether you itemize or not. The other three provisions, seniors, tip income, and overtime. For seniors age 65 and over, there is an additional $6,000 standard deduction. Again, a phase out starts at $75,000 for married filing separate and for single taxpayers, and $150,000 for married filing joint. One of the promises that President Trump had made on the campaign trail was to make Social Security not taxable. That didn't get pushed through, but this provision, this extra standard deduction, is seen as kind of delivering on that promise, just in a different way. Again, temporary, only through 2028. The other two deductions that are allowable for the next few years are tip income, and these are, again, above the line deductions, so it doesn't matter if you itemize or not. For tips, it is up to $25,000 per return, so it's not $25,000 per person, it is $25,000 per return. If you are single, you get that $25,000. If you are married filing jointly, you only get the $25,000. That phases out for adjusted gross income of $150 for single, $300 for married filing joint. And the Treasury Department did come out with a list of occupations that will benefit from this provision. There are 8 different categories in the thing that the Treasury put out recently. Little tongue-tied, sorry. And some of those categories include beverage and food service, not surprising, entertainment and events, hospitality and guest services, home services, personal services, personal appearance and wellness, recreation and instruction, and transportation and delivery. So there's a lot of occupations that will qualify. This will be the first year, 2025. The forms have not been updated yet to address this, so your employers will have to issue some type of a report to the employees so they know what their amount is that's eligible for this deduction. In 2026, the W-2 forms will be modified, so we will have more clarity with the 2026 forms. Overtime, and so anyone that is paid time and a half, the half piece of that payment will be allowable for a deduction up to $12,500 for single filers and up to $25,000 for joint. So this is a per person deduction, not a per return, like the tips is per return. And that has the same phase out levels as the tip provision. Moving along, one of the bigger changes, and this is also a temporary provision, is the charitable contribution changes. There is an above the line deduction for non-itemizers. You may recall that we had this above the line deduction during the COVID years, which kind of incentivized people to make charitable donations during that time. This is back. It's $1,000 above the line deduction for non-itemized for single folks, and then $2,000 for that starts in 2026. But keep in mind, it does not include donations to a donor advised fund or to private non-operating foundations. An additional provision that impacts your charitable contributions starts in 2026. This is where there could be some planning opportunities in looking at 2025 versus 2026. Starting in 2026, there is a 0.5% floor of AGI on charitable donations. So many people are aware of the floor that you have for medical expense deductions, right? For 7.5% of AGI, that first amount of medical expenses is disallowed and completely disregarded. That is what this new thing is for charitable contributions. It's a 0.5 of your AGI. So someone that has $1 million of AGI, 0.5 of that is $5,000. That first $5,000 of charitable contributions is disregarded. And this, again, this is for itemizers. And this haircut kind of also reduces the amount of itemized deductions that you have, which gets it harder to get to above that standard deduction line. An additional haircut that we will be seeing in 2026 on donations is the benefit for your charitable donation, if you do itemize, is capped at the 35% tax bracket. So if you in a 37% bracket, there will be an additional 2% reduction for that benefit. So another confusing calculation, but that is another haircut on the charitable contributions. So if you are thinking, there's some opportunities here, if you are thinking about whether to make a donation in January versus in December, you won't have that haircut this December in 2025. It also has the opportunity to think about the bunching strategy, where you try to put as many of your deductions into 2025 as you can to raise that dollar amount, and maybe you do itemize in 2025. You may also want to consider donations to a donor advised fund in 2025, because again, no haircut on that deduction in 2025. It is important to note these charitable contribution changes they don't impact the qualified charitable deduction. So the qualified charitable deduction, or QCD as we call it, that is when you make a donation directly from your IRA. If you are over the age of 70 and a half, those deductions directly from your IRA are treated as a reduction of your taxable income from a distribution from your IRA. And so there's no haircut on that. And we should continue to encourage our clients who have IRAs, who are over age 70 and a half and who have charitable intent. The best way to make those contributions going forward, especially, will be through your IRA. So that's something to keep in mind as we move forward. I think, a couple more things on the individual side. We talked about the child tax credit that does go up to $2,200 this year, and $1,400 of that is refundable. The green energy credits, anything related to electric vehicles, those credits expired on September 30th. There were adjusted gross income phase out ranges on those, so less and less people were getting benefits from that anyway, but those are now expired. And then home energy improvement credits will expire by the end of this year. So if you have any of those in the works, you want to make sure the work is done before the end of the year so you can receive those credits. This last provision on the 1099 thresholds, I think we're all very excited about this. Now the rule for 2025 and prior was that if a business paid an individual or an unincorporated business anything greater than $600 in total. The business was required to issue a 1099 miscellaneous or a 1099 NEC form to those individuals or businesses. That threshold will increase to $2,000 in 2026. So the 2025 tax year, the forms that get issued in January 2026, we still have the $600 threshold. The following year, we get to increase that to $2,000. So that should help on some of the administrative paperwork. Now, that doesn't mean that if you don't receive a 1099 because the income was less than $2,000, that you don't have to report that income. You are still required to report that income. However, you may not see a form come through if it is less than $2,000. And lastly, the 1099K forms, which is related to credit cards and credit card charges. That threshold had been brought down to the $600 threshold. That is effective immediately, retroactive back to 2022. It reverts back to $20,000 and at least 200 transactions. So that's another administrative burden that has been released from many taxpayers and many reporting agencies. Those are the high points for the individuals. And now I'm going to pass it over to you, Anthony.
Thank you, Laura. So now we're going to cover the OBBBA. I'm not going with the Star Wars reference because I'll screw it up. But so OBBBA for businesses. You know, it's interesting when the bill got passed. I got a urgent call from a client, and he was like, "Hey, this is great. The radio said my taxes are going down. This is great." And I very quickly corrected him. I said, "Your taxes aren't going down for the most part. They're staying the same, which is a win." And why that is as Laura said, a lot of the OBBBA provisions are extenders for a lot of good provisions in the tax laws that were set to sunset. And a couple big ones are, you know, let's start off with the QBI, the qualified business income. And this is the 20% deduction for pass-through business owners on the pass-through business profits. And that was set to sunset, but now OBBBA makes that deduction permanent. And, you know, that deduction is available for certain trades and industries, but there's a few industries that are just not eligible for QBI per the law. And we call those the specified service trader businesses, the SSTB. We love acronyms, us CPAs. But so folks that are in certain industries that are not eligible for QBI, these SSTB industries, they're eligible to take QBI on if they're in the moderate to lower, call it income brackets. So that they've raised those thresholds a little bit more, 75K single, 150K joint. There's a new minimum if your QBI income is $1,000. But really one of the key wins is that QBI is made permanent, and that gives you some certainty. If you're a business owner for planning, gives you certainty. So that's big win number one. Okay. Let's segue into what I call big win number two in the OBBBA bill. And that is that 100% bonus depreciation, which was ticking down. You know, you buy assets, you were able to depreciate them 100%. Then it was, okay, 80%, 60%, it's going down. That reverts back to 100% for any property placed in service after January 19, 2025. So for businesses, this is a big win. If you're able to go out and buy equipment, machinery equipment, anything you need, as opposed to depreciating it over several years or being limited on the bonus depreciation in year one to 60%, 40%, you now get that 100% back. And, you know, people always say to me, well, you know, that's great, but there's also Section 179. Well, keep in mind, Section 179 is the other depreciation rule that's out there for accelerating depreciation. It's increased. You can take the first $2.5 million, but there is a phase out. The other thing to remember with 179 is that if you're a business owner, you can't take 179 to get into a loss position. And you know, so whereas with the bonus, you can bonus into a loss, and if you've got basis, you can use the loss to offset other income. So it's just getting into some planning scenarios now. you've got to be considerate of, okay, I'm buying assets. Am I taking 179? Am I taking bonus? And I'll give a shout out to Erin Washburn on my team, who always makes me look smarter than I am, because I always forget this. You have to be considerate of states. So us folks that spend a lot of time in Rhode Island and Mass, they do not follow bonus depreciation rules. So you got to keep that in mind, is which depreciation am I selecting? We do work all over the world, but we've got a lot of folks in Rhode Island, Mass. Bear in mind, they do not piggyback onto the bonus depreciation rules. They do follow the Section 179 rules. So when we're working with new clients, new staff, folks, we always say, okay, let's look at 179 first. Remember, it can't create a loss. So it's one of those balances that we always look to do. But this is big win number 2. And Joe, I'm sure you would like to add something on this. I can see you.
Yeah, I would love to. I mean, obviously, this is one of the big wins for our real estate investors. Knowing who the president is, obviously there was going to be some benefits to those folks. And one of the big things with the bonus increases is now the cost segregation study is more valuable than ever, right? And so I'm sure everybody's aware of what that is. But essentially, a cost segregation study carves out some of the things in a building acquisition or a building construction build out that we can carve out into lower life depreciation and immediately take some accelerated depreciation. So now those deductions are worth more. So certainly if you've recently acquired a building or are doing a build out, the cost seg study is very beneficial in terms of tax planning, getting some cash flow up front. And obviously KLR, we are equipped to do those. So certainly reach out, and it's something that we can leverage now using the benefits here of bonus. And then just to expand on what you said, Anthony, too, right, is, a lot of people are very excited about creating, bonus depreciation losses. There are loss limitations at the individual level, which require careful planning and consideration. So there's, Section 461 business losses. So even though we're creating some of these depreciation deductions non-cash, some of those losses may be limited, including basis, at-risk, passive. So great thing that we can generate some losses here, but we have to be careful in planning and how that impacts our individual clients once we're flowing those losses through to them.
Right. And I'll say that's one of, I think, the strengths of our team here, is that we work through all these scenarios and we do the planning with the clients, and in collaboration we come together with a plan that's going to work well. Joe, I'll tell you, one of my next meetings this afternoon is to deliver some good news on a cost segregation study on a $3 million renovation of a commercial building. Looks like we're going to get somewhere between 1.75 and 2 million in assets that are eligible for bonus depreciation. So good win there. Sticking along the lines of the depreciation, there's a new rule, and manufacturers should really take note of this. If you renovate or buy a new building, you can get 100% deduction for the section of that building allocation that relates to qualified production property. So just along the lines of what Joe was just saying, with the bonus depreciation coming in, if you plan properly and you're a manufacturer and you've got a component of your building that is doing the production, you're eligible for this. And if you plan properly, it's a really, really good deduction. I would encourage you, as Joe mentioned, cost segregation studies with a big depreciation deduction like this. I would caution you that it's best to speak with Joe as well as our other partner, Meyer Levy, and work on a cost segregation study to really memorialize and support your position on this, because it could be really valuable. What's next for businesses? All right. Let's call this big win number 3, 4, 5, 6, 7, 8, 9, 10. So, a few years ago, there was everybody was familiar with R&D. There was a new classification called R&D. What essentially it said is, if you're spending money on research and experimentation, you have to capitalize and amortize that over 5 years, 60 months. And if it was foreign R&D, it was 15 years you have to amortize it. So this is the big one. We had a lot of clients that we work with, and I've talked to a lot of prospects. They've got this, call it, big tax bill they paid a few years ago because they were limited on, they were only allowed 20% of their R&D costs in year one, and then year two it happened again. So they've got these big balances of unamortized R&E, and they paid a lot of taxes because they weren't able to deduct it all in the year they spent it, as had been the previous rule. So in OBBBA, there's some good news in that going forward in 2025, you can immediately expense all of your domestic R&E. So you don't have to capitalize it, you can expense it. And now here's where the planning that Joe was referencing, where it's really something that we need to work together with, in that, you really have an option. If you're a small business under 31 million in receipts, you have the ability to elect to go back and retroactively amend 2022, 2023, 2024 tax returns and take the R&D then, as opposed to the amortization, the R&E, and apply for refunds. Now, I caution you, if you pay attention to what's going on in the world, we are in a government shutdown. You do have to amend the pass-through companies' tax returns if you're pass-through, and then the owner's returns on the K1s. So it sounds great. I'll just tell you, work with your advisor, because it may not be the way to go. Because if you think you're going to get these funds anytime soon, you may not see the refunds till 2027. So now, if you're not a small business, or if you're a small business that elects not to retroactively amend your return, you really have three options. You can do nothing. You can continue to amortize whatever R&E you have over that 60-month period and just let it play out. You have the ability in 2025 to do a catch-up and take all the unamortized R&E and take the deduction in 2025. Or you have the ability to take whatever unamortized R&E you have ratably over 2025 and 2026. And I, again, get back to planning is the key here, because you got to really think about, hey, what do I have for future profits? You got to watch what tax brackets you're in, as to, if you're going to make election 1, 2, or 3, where can I really optimize this deduction? And then, this is R&D. So most of these companies are also doing R&D tax credit. You got to kind of make sure the two entity, the R&D and the R&E, the credits and the deduction kind of work together to optimize the value of them. So that's R&E. And the one thing I will caution you is that even though we have this big win on the domestic R&D, I keep calling R&D, any foreign R&E is still amortized over 15 years. So with the focus of, working in America, I think what they're trying to do is push folks to use American businesses for the R&E, as opposed to the foreign, which will still be amortized over 15 years. Okay, lastly, for businesses, we'll call this big win number 11. If you're a business that has a lot of interest expense, the formula to calculate how much interest that is deductible in a year used to be based off of, There we go. Yep. All right. It used to be based off of EBITDA prior to a couple of years ago. And then the DA, the depreciation and the amortization, was dropped off of the calculation. So when you were trying to see how much base income you had that would be allowed to take interest with the 30% limitation, you weren't allowed to add back depreciation and amortization, which means there's a lot of companies that got a surprise where they were paying all this interest expense. The cash was going out the door for interest. They weren't allowed to deduct it. So within OBBBA, it restores the formula to determine how much interest expense you can deduct in a given year, from using an EBIT calculation to an EBITDA calculation. And this is a permanent change. So this is a big win, because you're going to be allowed to deduct more interest if you're a business that has a lot of interest expense. You could have elected to capitalize that interest and amortize it over a period of time, so you would at least get something. You can't do that anymore, and honestly, I don't think I ever saw any businesses do that the period of time that it was available. So that's a big win. And then lastly, salt is a hot topic, and we talked to Laura was talking about the salt 40% on the return. You can now take that for a Schedule A deduction, but PTE, we believe it's still very advantageous, because essentially what you're going to do is you're going to reduce that modified adjusted gross income that Laura was talking about, where a lot of these other calculations are based upon, if you take advantage of the PTE. So we would still encourage everybody to take advantage of the PTE, which is that pass-through where the companies pay the state income taxes for pass-through entities, and then get a deduction at the company level. One item of note, again, I feel like, we've got a lot of federal opportunities and issues here, but we also have to remember about the states. And we know that, like I said, we work in every state, but I'll highlight, for instance, Mass and Connecticut. They've always been around, you only get 90% of the amount paid under the PTE. You'd only get a credit for. For our friends in Rhode Island, effective this year, Rhode Island is changing the rules. So you're only going to get, a 90% state tax credit for the amount paid under the PTE beginning in 2025. So that's important to note. As I said, for years and years and years, we never really worried about the state. Focused on the federal. We've got to worry about the states. Laura, you look like you want to say something.
I was just going to add to that even with the haircut, when you look at, especially for high income earners, if they are in a 37% tax bracket, getting that federal tax deduction is so much more beneficial, even if you have to take a little 10% haircut on the credit that you get to claim on your Rhode Island return. So most times when you're trying to weigh, the benefits of the 10% haircut versus maybe taking the $40,000 enhanced SALT deduction instead, you're almost always going to end up on the better end of it by taking the PTE at the business level, getting that federal deduction, and you just have to deal with a little bit of a loss on the state credit.
Thank you, Laura. And one other thing I would remind our friends in Massachusetts is there's also the Mass Millionaires Tax. It's not in here, but I know it's surprising a few folks. Where if your income's over $1 million in Mass, there's a 4% surcharge tax on the additional income, which means your effective Mass tax rate for the next dollar you earn is 9%. And I know I've seen a few business owners get surprised by that in the last year. So I just want to remind everybody that's out there as well. And with that, I'm going to bring a man to the stage who has no fear of celebrating Movember. Joe, let's talk about opportunity zones.
Thank you, Anthony. I know this is what everybody's here to listen to, is the opportunity zone update. For those who aren't aware of what it is, let's take a step back. We'll go back to Tax Cuts and Jobs Act, and this was kind of a hastily written small carve out of the TCJA. And the whole goal of this program was to get taxpayers to invest dollars, capital gain dollars, into underdeveloped areas. And so this whole program was brought about to try to spur investment. And with that investment, taxpayers got a number of benefits. And so obviously this was, had a lot of buzz when TCJA came out. There was some uncertainty around it. And so we did have some early adopters. But essentially the benefits of this program all kind of revolve around whether or not a taxpayer has federal taxable capital gains. And if they do, they can take those capital gain proceeds and invest into these things called opportunity zone funds. And they get three main benefits. So one, there was a gain deferral, right? So we don't have to pay immediate capital gains tax on that appreciated sale. There was a step up in basis. So if taxpayers who invested in these funds held for a certain amount of time, they got a step up in their basis, so they didn't have to pay 100% of that deferred gain. And then third, the biggest benefit is, they wanted to make sure that people were doing these investments for a long-term period of time. So there was a 10-year holding period threshold, which we're not quite at yet for those who made initial investments. But if you held your opportunity zone investment for at least 10 years, and upon exit, if there was any appreciation on that investment, so if I sold Apple stock for $1 million, I timely invested into an opportunity zone fund. 10 years later, I put that $1 million and held it, and it became $2 million. I have $1 million essentially of tax-free gain upon the exit from my opportunity zone investment. So it was a massive tax opportunity, tax planning opportunity for people to take advantage of. And so as that happened, some of those benefits have phased out over time, but we have good news. And the good news is that the opportunity zone program is now permanent, right? So that gives people the ability to plan around their gains, look at investment opportunities, and take advantage of the program moving forward. So that's the biggest thing on OB3 is we now have a permanent opportunity zone program, and certainly I think more people will take advantage of it this round than under OZ 1.0. As part of that process, there was some original opportunity zones that each governor got to basically designate and filter investment into those areas. There's going to be a redesignation process every 10 years, and those redesignations are going to start 1/1/2027. We're going to understand more those redesignations starting next summer, but just because there is an opportunity zone in a state currently does not mean it's automatically going to be redesignated. So if you have current investments in certain opportunity zones in certain states, those zones may change, and people will need to review their investments, the funding levels, and then additional investments into new zones. It's going to be a completely different map potentially. So we're obviously going to work through that, and we're going to need more information from the various governors as to which areas they want to basically drive investment. A new wrinkle that was created as part of the OB3 and opportunity zones is these things called rural qualified opportunity zone funds. So they are going to put a big emphasis on opportunity zone funds being set up and developing land, commercial properties in these rural areas, and you're going to get additional tax benefits, which we can talk about. So what's coming back? The 5-year rolling deferral period. So that deferral is going to come back. So if I make an investment in after 1/1/2027, I get to defer that capital gain for 5 years. So that's a huge benefit for people. If we're talking large capital gain dollars, instead of paying the tax, you have those 5 years to invest, generate cash flow, certainly a huge benefit. The step up in basis is coming back, right? So if we hit our 5-year holding period threshold, we get a 10% step up. So we would only be paying 90% of that original gain after that 5-year hold. And that 10-year benefit is still around. So that's really the big win. Again, trying to drive long-term investments in these designated areas. So obviously with opportunity zones, the biggest thing is the timing around capital gains, and then making your decision whether or not you want to invest in an opportunity zone fund. And that decision, you do have a period of 180 days. So to the extent that people think they might want to take advantage of some of these benefits, certainly talk to us, talk to your tax advisor when you're going to be generating capital gains, and we can guide you as to the deferral timelines, finding investment opportunities, and making sure that you get in a timely investment. So the big thing here, as I mentioned originally, so under OZ 1.0, if you invested gains at any point from the start of the Tax Cuts and Jobs Act, you have until the end of 2026. That deferral period ends at the end of 2026, so 12/31/2026. If you have deferred gains, we need to start planning now, because those gains are going to be recognized in the same manner and character that they were initially deferred. So there's going to be a lot of folks that took advantage of these benefits that have to bring those gains back into their tax picture And we need to start planning now because those cash taxes are going to be due in April of 2027. So what can we do to potentially offset that and make sure everyone's aware? The planning tip is, right, these opportunity zones operate just as any other investment. If they're an LLC, there's a pass-through aspect. So certainly, you can look at how bonus depreciation, additional interest expense deductions, how can we leverage those to potentially offset our tax bill that's going to be coming due. So certainly now is the time, right before we get into 2026, to look at your entire tax picture and figure out how these OZs are gonna obviously impact the tax. And the last point, which a lot of people aren't thinking about, is the amount that you recognize at the end of 2026 is the deferred gain. So in my example, if it was $1 million that I deferred, I have to bring $1 million back in. But there's a small provision that it's the lesser of the deferred gain amount or the fair market value of your OZ investment at that point. So if that investment potentially lost money or is not fully developed, we may be able to utilize business valuations to reduce the amount that we're going to pick up at the end of 2026. And certainly that would help out in the overall tax picture. So overall, great news that opportunity zones are around. They're here to stay. People can still take advantage of OZ 1.0. Certainly they can take advantage of OZ 2.0 starting 1/1/27. And there's a lot of planning that needs to be done. So certainly reach out to us, to me specifically, your tax advisor, to start talking about this now so we have time to plan and make sure that everybody is covered. And I think with that, we're going to talk about Secure 2.0, which has a lot of other good provisions in there.
Thanks, Joe. Great stuff on opportunity zones there. So, Secure 2.0 is more of a refresher. This has been around for a while, but some of the items are actually effective. So it's important to be aware of them. What I will tell you about this is, as we all know, RMDs have increased to age 73 for 2025, goes up to 75 after 2032. Key with RMDs, the rules behind it: you must take the first one by April 1st of the year after you turn 73, and then every year thereafter by December 31st. Couple key things: you have to factor in all your accounts. Even though you can take the payment from one, you have to factor in all your accounts. So be aware, 401ks, IRAs, they may not be talking to each other, but you need a proper advisor to know that you got to look at all of them. And I always get the question, hey, I got this great tax strategy. I can defer taking the first one until April of next year. But just remember, in that year too, you have double distributions coming out. So you really got to look at that if that really makes sense. It's not whereas you used to. People don't retire at 73 anymore. They retire earlier. So it's a matter of you may not have a bunch of earned income one year from working on a W-2 and then taking the RMD. So that may not make sense anymore. As we know, Simples and SEPs can now have Roth contributions to them. So I would tell you the opportunity there is if you've got children and they've got earned income, even though you don't get a tax deduction for a Roth, it's nice for that income to earn tax-free for many years. Penalty for taking RMDs drops from 50% to 25%, but keep in mind there is a cumulative component to that. So if you don't fix it, that gets cumulative, and you may end up with minimal dollars in your account when you actually do fix it. So be aware, you can't put your head in the sand if you don't make your RMD. You should get somebody to advise you on fixing that. 529s, as we know now, 35K of that can be rolled over. Even though it's a rollover, it's actually a contribution, so it's like a 7K a year limitation. But 35K of those accounts can be rolled over into a Roth. For the higher income earners over 145K based on your previous year wages, you now have to make your catch-up contributions for over age 50 as a Roth. What I would tell you there is just make sure if you're an HR person or an owner of a business that sponsors a retirement plan, that your plan doc is updated to allow for that. Make sure you speak with your HR folks, TPA, 401k advisors, payroll companies, so that everybody's on the same page and that provision is in place. The 10-year rule on RMDs, get that all the time. There's different factors there. Who's the beneficiary? Was the decedent taking their RMDs before they passed away? So just be aware of that. There are different rules, and happy to work with you on that if you've got an inherited IRA. Next thing to be aware of, part-time, call it, employees are now eligible to participate in a 401k 403b after 2 years of service. The issue with that is if you've got a plan and you got over 120 eligible people, meaning people with balances in the plan now, you might need a 401k or 403b audit. So if you can get folks out with an involuntary cash out, I think it's 7K, update your plan document, make sure you get them out. If you're age 60, 61, 62, 63, congratulations, you can contribute another $11,250 into your retirement plan. But keep in mind, if you're a high income earner over 145, that's treated as a Roth contribution. And then happy birthday, you're 64, you're going backwards, you're not allowed to make them. So that's only for those 4 ages. Mandatory auto enrollment is here, meaning every retirement plan that is new must have a 3% auto enroll for new participants. 1% escalators are required annually, up to 10%. You can go up to 15% max, but participants must opt out of this now. So again, going back to, plan doc, who's responsible for your HR, your 401k advisor, payroll company, make sure everybody's on the same page, and everything needs to be updated by 12/31/26. So that is secure 2.0. And, I can't believe that we are still talking about ERC. It's been, it's going to be 10 years of my career. It's going to be probably 20% of my career where all I talked about was ERC. Audits continue to happen. Denial letters continue to happen. We need more info letters continue to happen. To remind you, 2020 ERC claims were due by April 15th of 24. 2021 claims were due by April 15th of 2025. The new rules say that if you filed a Q321 or a Q421 claim and it was not filed by January 31st of 2024, you're not getting paid on it. It's disallowed. If you have already received your Q321 or Q421 claim, you're good. They won't come back and try to get the money. But if you haven't received it yet and you filed it after January 31st, 24, it's being disallowed. It's because it comes from Medicare funding versus all the rest came from Social Security funding. But I get that question a lot. Audits for ERCs, most will be 3 years from those dates, but now it's up to 6 years, especially Q3, Q4 of 21, which means in 2030, I will still be talking about ERC, because if you had 6 years to 2024. But on top of that, I would remind you that there is no statute for fraud. There was a lot of bad actors out there. We just talked to a prospect who received a letter saying, hey, we need more info. We looked at the letter. It was actually an IRS audit letter. And they said that the current ERC advisor told them just to ignore it, let it die on the vine. You've already received some funds, let it go. Don't worry about it. I said to them, I'd be less worried about the audit letter and the claim you haven't received. If you don't answer to it, I'd be more worried that the IRS is going to come look at the claim you did receive. So when that happens, reach out to us, and we can connect you with proper legal counsel or ERC advisors. So hopefully that's the end of ERC. So Laura, I'm going to move on to you because I'm just so tired of talking about ERC.
Thanks, Anthony. So we're running a little short on time, so I'm just going to touch on a couple of other things. Let's see, get to the next slide. Back in March, President Trump quietly signed a presidential declaration mandating electronic payment for any payments made to the government and any payments made by the government. So that was to be effective 9/30/2025. So we've had a lot of clients. We quickly told them you still can make your check payments for your third quarter estimates that were due on 9/15, but going forward, payments will need to be made electronically. There are exceptions to who must do that, and that is exceptions for those who don't have access to electronic banking services, including those who live overseas or in remote areas. But other than that, The government is asking that all payments be made electronically. For tax refunds, we have to set up direct deposit. If you don't have a bank account, there is the likelihood that instead of a check, you may get a prepaid credit card coming back to you, or a debit card. The payment options for electronic payment, you can sign up for the electronic funds tax pay, EFTPS, I'm going to call it. That requires setup in advance. So if you're going to make payments in that way, you have to go to the EFTPS system and set up your account. You also can elect to have EFT withdrawal from your bank account when filing a return. So if you are electronically filing a return, most tax programs will allow an EFT withdrawal to be set up. And then you also can go directly to the IRS website. They do have a direct pay website, which is very easy to use. So those are your options for making payments electronically. I haven't heard yet what the penalties for paying by check are. We're in a government shutdown, so we haven't really seen much on guidance on that. I have to believe they will accept the check and cash it if that is sent in that way. However, you may get some type of a notice with a penalty, or at least a stern warning initially. So that's what's happening with the electronic payment mandate. News of the government shutdown, what's happening during the shutdown, what is the IRS impact? IRS has said they will continue the tax filing and payment deadlines remain in effect under the normal schedule, no change in those. They will continue to process payments received during the shutdown. Refunds will only be processed from 1040s that have been e-filed, error-free returns, and that have direct deposit instructions. There's limited live IRS telephone customer service, which is concerning because it was pretty limited before the shutdown, but there is more limitations. The IRS walk-in centers are closed, taxpayer advocate service and independent office of appeals, any appointments during the shutdown period have been canceled. Responses to paper correspondence are on hold, and any tax exempt status or pension plan applications will not be processed during the shutdown. Anthony, you want to kind of wrap up with the economic landscape?
Sure, it's three things. Essentially tariffs, and it's not that tariffs can't be managed. It's that there's so much uncertainty on what the tariffs actually are from day to day. So that's what we're hearing from all our clients. So hopefully there'll be some certainty with tariffs. Interest rates, they're on the horizon, lower rates are coming. So if you've got term debt, reach out to your banking friends and see what's going on with rates. There might be the opportunity to refi into a lower rate. And, you know, the one thing I'll tell you, we've talked a lot about federal, but I keep throwing the flag up. You got to remember your state and local taxes, what's going on. So you got to look at those opportunities. Does it make sense to maybe move income into a state where you're saying, I don't want to pay taxes in states? Well, you might want to pay taxes in a state because it might be at a lower rate. So that's what we got going on really with the economic update: tariffs, interest rates, and state and local taxes. Some tax planning strategies to consider. I guess we can all jump in. I'll let Laura jump in.
Well, I welcome each of you to jump in as well, but obviously business succession planning, whether you're thinking about in the future selling the business or transitioning it down to the next generation, there's some planning to work on for that. Obviously, gifting strategies. Are you going to do your annual gifts to family members? Are you going to maybe make a big gift and utilize some of that lifetime exemption? Retirement plan contributions, there's time for that. They don't necessarily have to be done before the end of the year. A lot of times you have until April 15th or until after. If you extend return, you have until the extended due date. And timing of fixed assets, furniture, fixtures, and equipment expenditures. Should you make those payments and investments in 2025 or put it off till 2026? Joe, you talked about harvesting capital losses and maybe some timing there. You want to touch upon that, especially as it relates to
certainly as it relates to OZs, right? If we think obviously we're going to have potentially large capital gain in 26, we may want to look at with the financial advisors whether it makes sense to harvest those capital losses now, carry them over, or offset current gains. And so there's certainly some planning around that. To your point, Laura, I'll give a shout out to our growth and transition services team on business succession. If a large portion of your net worth is your business, obviously, and you're thinking about selling in the future, the time to look at that is, 2 to 3 to 4 years prior to that. So reach out to us and we'll put you in contact with our GTS team that can help you navigate all of those things.
I think we've run out of time. Can't believe how quickly time flies. Madison, do you want to close it out for us?
Absolutely. Thank you so much, Laura, Anthony, and Joe, and thank you to everyone who joined us today. While we didn't have time to hit on questions, we'll be sure to connect with you offline and answer any questions that you may have. So feel free to reach out. As a quick reminder, you'll receive a follow-up email later today with a recording of the webinar, a copy of the slides, and links to download our 2025 year-end tax planning guides for individuals and businesses. If anything additional comes up, please don't hesitate to reach out. We're always here to help. So thank you again for joining us and have a great rest of your day.
Thanks, everyone.
Thank you.